This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of this Smart Property Investment Show. Well into our over 1,000 episodes of this podcast. It's crazy. I was thinking about it the other day and how many people I've spoken to over the years when it comes to property. And for some reason people think I know about property. I don't really know that much. I know enough to be able to talk to people who know a fair bit about property, and that's essentially, I've made a living out of it. But I do enjoy property. I enjoy the outcomes of good and smart property investment. Sometimes I don't necessarily like the administrative aspect of it. Everyone gets excited about buying property and where to buy and how to buy and when to buy and how does it fit with portfolio growth. And then you get to this malaise and fatigue of owning and managing a property portfolio, not a small one. And there's a lot of negatives and rather than the positives around it. One of them is tax depreciation, which I've finally got sorted out on a whole bunch of different things. Something that, like most people, you might not get excited about tax depreciation. A lot of people don't really like getting excited about meeting their accountant. I actually like meeting my accountant. I get excited about that. I challenge him. I probably know enough to be a bit dangerous and I can ask challenging and posing questions, which I think he enjoys. But there's bits of property investment which are often overlooked, and tax depreciation is one of them. I've spoken about this before, and I spent some time considering coming up to the end of the financial year to finally sort things out, which I've done. I've had the team over at BMT Tax Depreciation do 4 reports for me pretty quickly, which is pretty cool. Whether or not they've looked after me or that's your usual service, I'm not too sure. I think it's probably the latter rather than the former. But the team over there has been good. They've chased me. I've got it finally sorted out, and I've got in my hot little hand all these tax depreciation reports, of which I look at them and they look pretty foreign to me. It could be written in Chinese, let alone English. I don't know anything about it. So what I've done, I've asked the CEO of BMT to come and have a chat with me to take me through my tax depreciation reports and answer a whole bunch of questions, which I assume are exactly the same as the sort of questions you're going to ask. So we'll get it straight from the horse's mouth. Brad Beer, he's a good friend of Smart Property Investment. I've known him for years, CEO of BMT Tax Depreciation. Brad, thanks for coming down.
Phil, always great here. Look, I also love talking about property. I've been an avid property investor for many years and hanging around at BMT for 26 years. So talking to property investors.
You've probably spoken to more property investors than I have.
I don't know, Phil. I guess it's quite possible. But,
I reckon you have done.
You know, what'd you say, 1,000 episodes?
Well, over 1,000 episodes.
And when was the first one?
It's nearly 10 years ago.
10 years. Okay. So... Yeah. It's a lot of podcasting about property, and you know I get a little bit more excited about the depreciation bit than you do. Probably.
And I don't want to. I'm conscious. I don't want to belittle tax depreciation because it's a very, very important part of property investing, but it's probably the most often overlooked part of property investing. And I'm certainly a case in point.
Absolutely. Look, absolutely important. And I guess the big core reason it's important is firstly, it's usually the second biggest tax deduction you make. We all know about interest because we have to pay heaps of it out, especially these days. And that, you know, we understand that the losses or the things related to interest are tax deductions. Depreciation is usually the second biggest deduction, and it's a non-cash deduction. So you don't actually pay that money out each year. Hence, it makes a really big difference to the cash flow. And it's after many years of knowing you, Phil, and knowing that the administration part's not what you love that much. At least when you get them together, you get some money back. You're hopefully happy with those investments, and you got some more cash in your pocket.
It's also the gift that keeps giving every year. You know what I mean? Like, and you make a very, very good point. Everyone is so dialed in on what the interest rates are, and like we don't talk about tax depreciation that often, but you raise some really, really important points in it. It goes to show that this should not be overlooked by property investors, and it should not be something that you have to do because your accountant has told you to do it. This is something which everyone always talks about cash flow when it comes to property investment and what my after post-tax, you know, pre-tax and post-tax, right? When you talk about post-tax, the depreciation component of it will be a huge enabler in changing that.
And so much of the work that we do, which is great, is comes from the accounting industry, and the people call us and you know, 26 years ago, most of them called and said, my accountant, what on earth do you do? Now, there's still quite a portion of people that call and say, my accountant said I need one of your things. What is it? How much is it? And I kind of think when I get that call and talk to those people, like you bought this property without And, it's not the most important thing. We're going to make money out of property by buying the right property in the right place that has the right stuff and the right ability to grow for whatever reason. And depreciation is part of the cash flow. And it's not the first thing to think of, but it's something that at the time you should also crunch those numbers and go, how much after tax is this thing actually going to cost me with all of the things included? And I still get a little baffled sometimes with the amount of people that, especially – when it's a newish property and the deductions are high, there's, if you didn't know, last year's average first year deduction out of our reports was about $9,000.
Is it really that high?
So that's the average.
So that's $9,000 that you haven't had to pay, but you get that as a deduction on your initial tax return connected with the first year of that property.
Absolutely.
So that changes how much tax you pay.
Yes.
In a really, really simple setting, and I'm a simple bloke, you know this, it means you pay less tax.
In a simple setting, absolutely less tax, a $9,000 tax deduction that you don't pay with a few other, without getting too detailed about those.
Around it,
It's really that money back at your tax rate.
So you couldn't say this, but I can because this is my podcast. You're an idiot if you don't do tax depreciation reports.
I won't say that. It's your podcast.
Yes. But it's like if you haven't done this, and I'm one of them and I've fixed it now, I'm an idiot. Like you talk about that. So these are deductions that I could have been getting that I haven't been getting because I hadn't done this.
Pretty much.
Probably.
Yes.
Okay. You should put me part of your marketing team. Don't be an idiot. Do your depreciation.
Well, as much as we love our governments, I don't know that they spend – I don't know if we should leave our money there because I don't know if they're the best at spending it,
No. And this is a whole – and one of the great upsides with an organisation like BMT is that, yes, you do tax depreciation reports very, very well. You've been doing it for many years. And you do more than anyone else in Australia, right? You're the largest.
Multiples of.
But you're also a property investor. So you actually understand the utility of the work that you provide other Australians.
And and the first property I invested in was over 20 years ago now, and I still have it. And the great thing is I got my job at BMT. It was a work experience to start with, actually.
Yeah.
And what I got to do fairly quickly was go along and learn from an industry when I learned how to do one little piece of this. And I've been to more property seminars and things
Anyone I know.
and real estate stuff, property investment stuff, if you want to call it that, than probably just about anyone. And one great benefit is I was often the depreciation speaker, and I didn't have to pay to go along to these things, but I sit and listen so I can fit it in with the day and learning as much as I can across from multiple places, formulating the strategy and buying the properties. And I started doing that way back, I think, in 2001, buying, renovating, small developing and having some fun on the way,
I think we even once invested in the same, like there was a whole bunch of
yes,
a whole bunch. Have you still got that place?
I still got that place.
I still got it as well.
Yeah, I don't sell.
No. It was like a townhouse,
little townhouse development.
We didn't buy it new. It was
only a couple of years older.
Yeah. I think we got pretty good depreciation on that.
Good. They would have had great depreciation.
Yeah.
I found a guy.
I remember I spoke to you and you just got yours revalued and I went, how much?
Yeah.
I raced out and got us revalued as well, took the equity out of it.
I got that valued and refinanced it whenever we had that discussion. It was a few years ago now. And I'm thinking, I didn't think it was worth anywhere near that. But
no.
I do find that and what's one thing about investing in property is I've just been going through and doing some valuations and freeing up cash as you do recently. And I put these numbers on. And I was under on many of them. And normally when you're putting in the valuation number, you're putting more than you think. So, it's nice to have a pleasant surprise.
Happy days. I'm still – what's really funny is and this is in the Smart Property Investment portfolio, I'm still arguing, if you want to call it that, with the property manager, right, going trying to increase the rent on it. I'll tell you off air, some of what it is because I think your place is probably nearly identical. And I'm going, in that area, it's in eastern suburbs of Melbourne by memory, I think.
Glenroy.
It's in Glenroy.
Yes.
I'm going 3-bedroom townhouses in that area is this much. And they're going, yeah, but they're 3 bedrooms a little bit close to the station, blah, blah, blah. And I go, oh, okay, I give it. They go, okay, 3 bedrooms. They're going, it's not 3 bedrooms, it's 2 bedrooms. I'm going, no, it's 3 bedrooms. And they go, no, it's 2 bedrooms. And they go, we've been there, it's 2 bedrooms. And I went, all of my notes say it's 3 bedrooms, and I go to realestate.com.au and it tells me it's 3 bedrooms. So this is like how you could sometimes be a little bit disconnected with your portfolio when you actually don't know how many bedrooms there are. So I've gone, can you go there and have a look and tell me how many bedrooms there are? I can't remember.
Don't actually know how many bedrooms in
I
one
know.
of those either.
It's
I
crazy.
thought it was 3,
it's
but
crazy.
I could be wrong.
I swear it's 3, but anyway, I digress. So I've got a depreciation report here, and this was done by your crew very quickly, by the way. So thank you. And a quick shout out to Felicity Hector, who I don't know, you probably work pretty closely with her, but yeah, she's been excellent coordinating 4 or 5 reports that we did all simultaneously because I was trying to get on top of stuff. We'll get into that. But I get this report, Brad, and, and I've tried to print it out. My ink's not that good, so it's probably makes it a little bit harder. It's 33 pages. Like, I look at that and just go, God, I don't know, what am I going to do with this? So I just give it to the accountant now, right? And by the way, Felicity's been working directly with my accountant, which has been excellent. Yeah. I haven't had to do anything. How much of this report is like a good, credible, reputable document which has sufficient robustness to satisfy the tax man versus how much of this do I really need to get into? And I'm a practical investor.
Yeah. Now, there's a lot in there that kind of explains what it is, what it's about, why we've done it, where it is, the methodology. The methodology. Well, the accountant no longer needs to read the methodology. At the end of the day, the important thing is there's a couple of numbers that you claim each year, and this, keeps on giving for 40 years after it was built. I don't know how old that property was, but there's deductions each year. So we give it to you once, and really there's a couple of numbers on each. There's a couple of numbers each year that you need, total deductions for plant equipment if you've got that, and some of those need to be split into different areas. But there's a couple of numbers that are all on pretty much the same page.
Yes.
That is the only thing you'll actually use in your tax return each year.
Yeah.
Now, if you do get some more questions around how it got there, then you'll need some of the rest of the backup potentially. That's going to give you pretty much most of what you need there.
Yeah, capital works allowance.
That's most of what you need. Now, so, there's only really a couple of numbers and the rest of it's supporting info, or if you do sell, you might need a couple of different numbers. Your accountant will know which ones they are. But it also, because we project it out for all of the time, it's not you don't have to come and do it again next year. You just look at, you can see year 1, year 2, year 3, year 4, or back claims for previous years if you need to.
And this is a really important point, and I was going to get into it, may as well chat it now. I was going to go to break, but you only need to do this once. Or if you do something significant, you've got to do an update.
Yes. We project it out. Look, if depreciation claims relate to the cost of building and the value of things that are in there, if you want to simply, but if you add something else, even if you just add a new stove because your stove breaks, then you've changed what's there, you changed the costs, and you've changed your depreciation amount. And then so the new stove needs to be added and the old stove needs to be scrapped. So there's a couple of little changes even with just a stove, because there's value left in the old stove. You want to take advantage of that and write it all off straight away. We call it scrapping. Yep. It's not the technical term, but that's the one we use. And then the new stove needs to start depreciating. So that kind of changes the numbers each year. But if you do a lot of changes, new kitchens, bathrooms, then you'll update the schedule. If you just put a stove in, you're going to actually just get on the portal online and put your new stove in. I can't
remember how much of one of those reports is a one-off report?
Yeah,
what's the standard cost?
About $700.
Okay.
Normally $700 plus GST.
Okay. That's pretty
tax deductible, and that includes us doing everything. How much did you have to do? Not much. We talked to your accountant a bit.
I did very, very
you
little.
said, I'll have one, please.
I sent an email and said, can you guys coordinate all this for me? And it's what a good accountant should do as well, right?
And, gave us the address so we knew where to go.
Yeah.
And from there.
So you spoke to the landlord, the property manager, found a time to go and see them. There was a few up in Queensland. There's one in. So you guys do all that stuff.
So, our team, my team, organised to, via property manager, to tenant, organise a time, drive one of our little BMT Corollas around there and take some photos, some information, come back and produce that estimate.
It's a decent report, right? But it's a utility of the report, which is the important bit, right?
Yeah, your accountant goes and looks at the few numbers he needs out of it and uses it each year.
Plugs it in. That's good.
Yeah.
So I've got some other questions here. We'll get through them. We'll just go to a quick break. Stay with us. Back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show, chatting with Brad Beer. He's the CEO over at BMT. How many depreciation reports you reckon BMT has done since you were one of the first employees and now you're the boss of the joint? But how many?
900 and something thousand. I was there a year after the start and I was the first employee, so I've been involved since just about all those.
Pretty much everyone. So when will you clock 1 million?
Sometime next year I'd hope to clock 1 million depreciation schedules.
That's just bonkers.
It's a lot. There's a couple of million or more property investors or properties in the country, so we've done a good chunk of them.
You've got a huge market share then.
Yes. Look, I've got about 200 staff. We do good numbers of these every year. The market itself is a little hard to measure in some ways. We can see the number of new properties delivered and transactions and loan data that tells us how many investors kind of have invested. Some properties, if they're really old and had no work done to them, aren't worth it. So which is where the difficulty in the actual market is to measure. But we have a very good chunk of it, and we've done that simply by making sure we turn around nice and quick and make it easy.
So you must have such a repository of information about the journey of properties through Australia. You've probably done depreciation reports on the same property multiple times, particularly sort of investor type stock, right?
Sometimes, yes.
Yeah.
And then if we've done it before, it's usually it's an update for a new owner.
Yeah.
We rejig and make sure it's working the best for the new owner.
So back to the point before we went to the break, if you do some work, say you do a reno or you knock out some walls or put a kitchen or stove or new dunnies and bathrooms and stuff in, does it cost a lot more to actually get it updated since you've done the original one, or it's just a variation?
No, it's a variation.
Yeah.
Depending on the reason we are there as a quantity surveyor, it comes down to cost. So when you buy a property, you don't know how much, what you paid for it. You don't know how much it cost to build, how much each of the things cost, and the tax rules that we apply to those to get the most out of it.
Yeah.
If you put a new stove in, you don't need my help to tell you how much it cost.
Yeah. Send an invoice over.
Yeah, exactly. So that's a simple update, which you can actually go on the portal and do yourself. We don't even need to touch it.
Okay.
When there's other costs associated, we need to sometimes split them out into between plant and building and make sure we do whatever we can to maximise those deductions. But it's an update. It's not a start again.
Yeah.
And how much work's involved in that. Free if you just update them yourself, a few things. There's a few things we've got to look at. It's a minor update to the report.
So let's see how good you are, seeing that you've been doing depreciations for some time. I've gone to page 29 of the report, Brad, which is glossary of terms. And I look through this, and it's important. I'm going to have a bit of go at you here, but there's method to the madness, right? And this is to give some sense of the building blocks of a depreciation report, right? There's a whole bunch of you guys are experts at this, you know it inside out, but these are how there's rules around how this takes place for the purpose of creating depreciation reports, for the purpose of property investors using it as a tax deduction. And these things change and sometimes change. A lot of times that you just breeze over it, but I'll just pull out a couple of these terms. Let's start with Division 43. Can you tell me what Division 43 is?
Well, Division 43, it's lovely that the tax office comes up with great terms, formerly known as Division 10D.
Really?
Yes. They changed that. They called it Division 43. Or also known as capital allowances. And what that relates to is the claim relating to the structure of the building, effectively, the concrete floors, the walls, the roof, the things that last a long time, I guess, the fabric of the building. That's not what the glossary is going to say. I'm giving you this simple explanation.
Yeah.
And it's something that we put a cost or cost at the time of construction on the building itself and those items that are covered by that claim.
Yeah.
And we get to claim 2.5% of the cost of that each year. So if it's new, that goes for 40 years. 2.5 times 40 is claiming all of it.
Yeah.
If it's 10 years old, you've got 30 years to go. But we are actually estimating what it would have cost 10 years ago to build that house or do that renovation, basically.
Okay, and we're not videoing this podcast. Normally I'd video these. We're not videoing today, but I'm reporting here for those that obviously can't see that Brad has no idea I was going to do this and he has nothing in front of him. He knows his stuff inside out. And it's an important point. Tell me then, Brad, Lee, Division 40.
Division 40 relates to the plant and equipment items in the property. We have sort of said plant and equipment a couple of times.
Yes.
It is the carpets, hot water services, stoves, blinds, curtains. The tax office puts a list of these things out and puts what's called an effective life on them. So they say that, your carpet should last 10 years, even though we've said your building's got a 40-year life effectively. Your carpet with a 10-year life means we kind of claim its value over a 10-year period. So these, in order to claim against that Division 43, it only needs to be built if it's a residential property after 1987 or renovated in some way after a couple of different appropriate dates, depending on what it is. The plant and equipment is just the other stuff. It doesn't have an age date like that. In order to claim it now, it needs to be not previously used or new since 2017. That's come in. And it's, the things that, they generally don't last as long, so you get to claim them faster. And depreciation is that. It's actually claiming the decline in value of things over a period of time. And that Division 40 relates to the plant equipment component.
All right, the final one. There's heaps more other ones here, but I just want to make a point.
Just see if I know my stuff.
Yeah. Low value pooling. That sounds really exciting.
It does. Low value and low cost pooling. Well, now you're picking them out. So
you've got low cost asset, low value assets, and low value pooling.
Yes. So when you buy these plant equipment assets, they have that what we call an effective life, or what's called an effective life, which means they come out and it calculates the depreciation rate. But if you have one of those that has a value of less than $1,000 up front, then rather than doing its normal effective life claim, it gets dropped into what's called a low value pool and claimed at a higher rate, quicker. So it gets written off instead of its what might be 10 or 20%. It gets a 18.75% in the first year and 37.5% in the following years. And that applies to, it doesn't get prorated in the first year. So there's just a different way of calculating the depreciation on that item, but it's actually a bit higher. So we apply it because it helps to get more deductions. And it does also, it comes down to the low cost and then the low value pool, where if in the third year it drops below $1,000 in value, it gets dropped into this low value pool and claimed higher. And that's how we go and maximise deductions with all those funny things in the glossary of terms there, basically.
Right. So the point is that this is a specialisation doing this, right? If your accountant goes, don't worry about it, I'll do a report for you. You don't need to go and let me do it, right? Like, you mainly do work for accountants, right? Most accountants know that this is a specialised discipline.
Absolutely.
Yeah. And you do it a lot more effectively, I would imagine, and cost effectively than probably I'm generalising, but
so there's knowing the rules around the tax. There's two pieces in us doing a depreciation schedule. One's about compliance and construction costs. Like, the accountant doesn't know, with all due respect, know much about construction costs. We're guys that count bricks and tell you how much they cost.
Most accountants, and some, not most, or many accountants, really aren't property specialists at all. Like, it starts there. They do small business stuff or mum and dad tax returns, right? Like, so if you're in property investment, if you're tuning into this year, at least investing in property or thinking about investing in property, make sure you choose an accountant who actually understands property is the first point.
Absolutely.
Then you've got all the other stuff.
And if they think they're going to do it themselves, or sometimes they might think, it's old, it may not be worth it, or whatever. Old properties still get some deductions, not as much. But, I mean, at $700, we actually go and visit the place. Yeah. We measure it up. So an accountant who says, I'll just put some numbers in here, the thing they're going to do is put a conservative number in there anyway, because they know they would know, or anyone that does try to do it with a cut corner somewhere. We go, we visit, we find everything, we put it on the line, and we're not scared of it, because if you get an audit, we go, hang on, we went there on this date, here's a photo of what it is that was there, that we actually saw, and we applied a tax rule to that and a cost to that to come up with the highest deduction we legitimately can, which means more money for the property investor. And I don't know about you, Phil, but I was investing in property to make some money, so I really want as much as I can out of that.
Yeah, and that comes back to the point of actually doing your reports, and it's probably the second highest expense line you can put into your business, your property investment, small business, a small rental accommodation business, and anything else. So you'd be mad not to be doing it. So I'm happy to report that Brad actually knows what he's talking about. Who would have thought after 20-something years?
Pulled those questions out of the back of reports.
Did you ever get sick about talking about depreciation?
Look,
So let me reframe that question. How do you associate the work you do as a business, and it's a business that makes money, but it's for property investors. So it actually has utility and a better outcome for property investors, the work that you do. And that's probably connected for you, I would imagine.
It does. And also, I spent a lot of time doing, training to people about depreciation through the property and the investment industry. And I meet different people at the start of that journey on a consistent basis, because most investors in Australia only buy one.
Yeah.
They're not all, they're not all moguls with lots like you, Phil.
Well, this is why I do this podcast. So people can try and emulate. Imagine sitting there going, I just want to be like Phil Tarrant. How sad is that? How sad is that?
Most people don't go on the journey of multiple properties. And it's, I think it's a way for people to generate some wealth and hopefully not live off the government at a later point in life. If you learn how to do a little bit about that, it's got that opportunity. So I see that we get to help some on that journey. And I mean, my challenge to me, 26 years in this business and going out and taking a photo of a bit of carpet is probably not what I get up and go, wow, I'd be excited to do that today. But the challenge of helping, I guess, an industry of people learn about it, do it properly, the challenge of, getting in front of a bunch of people and getting excited about something called tax depreciation.
Yeah.
That is a challenge for me. I love being in front of people and talking about that and doing some work around that. I've been around the country a lot of accounting and real estate related things over the last few weeks. I got called a FIFO by my wife today, I think.
Oh, yeah.
Which is interesting.
Well, he's not wearing fluo, by the way. I imagine he'd probably like to.
But and that's this time of year where it's around tax, and that happens for me. And I'm still heavily, 26 years, I'm heavily involved and active in this business in front of the people, and I still love it.
And I see you out and about everywhere, right, when it comes to real estate and specifically accounting. And we're at a function today, the accounting conference and expo is on in Sydney, and then this culminates tonight with the Australian Accounting Awards, big awards program, which will be at that. That's pretty cool. But yeah, I can report Brad's out there, and it's more beyond just education around depreciation. It's a holistic view of property and property investing. I know you used to do a lot of TV stuff. We used to go on the same shows back in the day when TVs were a thing. Now podcasts are a thing, which is pretty cool. But I get the connection, and to me, successful property. I'm talking about doing 1,000 episodes, right? Successful property investors don't just concentrate on one thing. They're largely generalists and holistic, and you don't need to be an expert really at anything to be an effective property investor. What you need to be good at is understanding the building blocks of property investment and ensuring that you're getting the right people to support you with the appropriate parts of that. And it is many and it's varied. There are so many moving parts to a portfolio, whether you're buying, whether you're holding, whether you're selling, whether you're preparing for retirement. But you've got to make sure you get the right experts in place at every step of the way. And, I sort of joke a little bit about depreciation. I think you've made the point that it is important from a cash flow point of view, and it will change the final number you will probably pay in terms of tax or get a tax deduction. So it's bloody important, pardon the French, even though it is often overlooked. And I'm one of those people who haven't prioritised it, and I'd like to think now that I have prioritised it, which is good. However, you talk about end of financial year, and we're sort of nearing it now. There's, about 10 days away. So everyone's sort of been obsessed about end of financial year. So I want to specifically talk about that in relation to tax depreciation. Just stay with us, back in a moment. Welcome back. Phil Tarrant chatting with Brad Beard. Now, Brad, end of financial year is looming. You don't have to hurry up now to get your 2020, your depreciation reports done for 2024, because you only need to get it done before you actually lodge a tax return. And essentially you've got until May of next year at a stretch to do your 2024 tax return. So I want to get a sense of timing around end of financial year. Why would it be important to get it done now versus get it done further down the path in July or August or whatever?
And there's probably a two-part answer to this question, I guess, Phil. And the depreciation claims that you get will not change if I do it for you this week or next week or July or August. So the amount you actually claim for depreciation is the same. We'll get to that in a moment. The only thing that does change between the 30th of June and the 1st of July is that our little piece of that bill that you need to pay for in order for us to go and do our work is something that is claimable. It'll be claimable. It's a tax deduction. We like tax deductions. It's claimable in the year that you pay for it. So if you're going to do it for this tax return, if you're going to buy it in July, you should buy it in June, or at least order and pay for it in June. Even if we haven't finished it, that doesn't matter. As long as it's ordered and paid for in June, you'll claim our bill as a tax deduction in this financial year. Lots of people pay up to this time because of that reason. If you're slack and slow and you do it in July instead, then that's fine. I'll still do it. No problems. Probably should have paid in June, but that's okay. The important thing is that you'll need it for that tax return. And before you do that tax return is the time to get it done.
Yeah.
The really important thing, like we all worry about 30 June, start thinking about tax, and we tell everybody it's 30 June, get it done because you claim the bill in this year, is that if you haven't been maximising it and doing it properly for whatever reason, you know, your accountant guessed or someone guessed or you guessed or you thought it was whatever reason, right? If you haven't maximised it, and I would say from my experience that 75% of people are not maximising the deduction properly. They're missing, they're leaving. If they're not leaving all of the money on the table, they're leaving some of the money on the table for whatever reason. You're able to go back pretty easily and adjust 2 tax returns and go, last year I should have claimed $8,000, I claimed nothing, or I claimed 5, whatever it is. You can go back and say, I want to fix up my tax return. But if you do another tax return, that's one less to go back.
Yeah.
So the most important thing around tax time for me is don't do another tax return and miss out on another one from the past. Because if there's, like we said earlier, the average deduction is $9,000 in the first financial year. If it's 9 plus 9, why would you miss out? Because you were worried about spending $700 or whatever the reason is.
Yeah, you'd be silly the question of price, and you know we know BMT, we know BMT well. I've functionally and actually paid for my reports this side of the financial year. That was the advice from my account because I'm getting ready to do my financials now. You know, I've looked at the number. It was a worthwhile exercise to do it. I'm not behind as a result of paying $770 to do my depreciation report. I'm ahead of the game.
No, I didn't poke my nose into your jobs either, Phil.
No.
So
There you go.
they got done, and
Well, I imagine much like what happens here with podcasting is that you've actually got some very talented people who do all the heavy lifting, Felicity being one of them.
Look, there's 200 odd people in BMT, and if I poke my nose in, they probably end up going slower because they're waiting for me to check it or something, right? But it runs through a system. I've got 26 years. We've any mistake we've made, we should have made by now, and we have a system to try and make sure we don't make it again.
Very smooth process. Very smooth process. I'm saying it as a customer, right? Like if I'd love to give you a hard time about it, but I can't. So I've got to say as it is.
But the thing that we are very, I guess, careful of up front is, like, we haven't really talked the nuts and bolts of it too much today, but the average is that there's new properties get more, old properties get less. There is some properties that there's not enough depreciation there.
Yeah.
But we identify that before we go and spend your $700 to tell you get 5.
So you'd actually go, guys, it's not worth it.
Yes, absolutely.
Okay.
Even
so something built in the 1920s that's fallen down, some fibro mansion
that no one's done anything from, then we might tell you no. But you know what? There might be something you don't know about that property that we can see from the initial look at the photos that we can find that there's money there. So don't, as an investor, every time you buy a property, call up the quantity surveyor, ask if there's anything there. If they tell you there's nothing, if I tell you there's nothing, there's nothing.
Yeah.
It's not worth it. But before we go and spend your money, we'll give you that advice to start with, and we'll back that to say if we don't get double what the cost is, then we just say, well, let's just walk away. Even if you've already paid, we'll give you the money back and say, if there's not enough there to make it worth it, don't spend your money, even though we may. But Phil, after we've done so many of them, if we can't look at some data or information and photos and have an idea whether it's worth it, then
how are you going to celebrate $1 million depreciation? You've got to have a big party, right?
I haven't thought that far, or haven't actually got anything in place yet. But
we might help accelerate it. Everyone's sitting there like me going, I haven't done my depreciation. I want to, quick, hurry up. There'll be a big party. There'll be a big party.
There should be a party at $1 million of those.
Oh, God. There should be a massive party. A massive party. I'm sure I'll be in the VIP section. So a couple of things I want to clarify then. So if you're like me and you haven't prioritised this, and as I said beforehand, if you're not doing it, you're a bit of an idiot. And I'm talking about myself there. Don't be that person. Don't be me. Learn from my mistakes. You can fix it. So you can do it, and so you can do the current tax return and 2 years before it. So you can fix up, you get the benefits for this year's plus the 2 preceding years.
Absolutely.
That's an important point. So it's not too late.
Not too late. And even I'd say send in what you're claiming. Tell us, I claimed $3,000, Brad, last year, and this is my property. And we'll go, I don't know, that looks like an okay amount. Because if someone has guessed it, then let's tell you whether we think it's enough.
So you fix $5 haircuts. You're one of those guys, right?
No, that's
the old adage.
Fix the $5 haircut. But, instead of my normal fee of $100, it's $150. No, that's not the same for us.
No.
The fee's the same regardless of whether you've, So
it doesn't matter how big the house is. Like, imagine if it's a super duper house, it might be a little bit more expensive, right?
Standard residential property.
Yeah. Because I've got you guys to do something from other stuff of mine, which is not a standard residential house. So obviously there's a lot more work goes into it.
And I guess the same. It's like commercial properties. Absolutely.
You do commercial as well?
Yeah, absolutely.
Okay.
Yes. I still, after so many years, have to answer that question sometimes. But you're working a lot in the residential space with the investors, Phil. So, but commercial as well, actually, now I think about that. So, yes. And it doesn't have those rule changes in 2017.
That's right.
So it's quite lucrative in the non-residential space. Do all sorts of things, right from the Melbourne Eye.
Have you got? Well, I was going to ask you. I actually just wrote down a question. What are the strangest properties or most interesting properties or assets that you've done? So you depreciated the Melbourne Eye.
The Melbourne Eye?
Yeah. You do the block stuff as well, right?
Do the block stuff. I've been down to the new one that's just being filmed at the moment.
Can you tell us anything about it? You signed a big fat NDA on that? No NDA this time? What can you tell us?
I can tell.
Because I know Tom Panos quite well, and I know he's always involved. He's the block auctioneer of the stars these days, and he's pretty tight-lipped.
They look pretty good. They're small houses. Phillip Island, yes. I went down there for the one day of the week. It poured rain and I'm running around in a suit and mud everywhere. It was fantastic, Phil.
Did you have your R.M. Williams on? That would be the...
No, I should have.
Yeah.
But no, we went and filmed a session on splitting up the construction costs and we've worked out some depreciation numbers. Yeah. As usual, they spend heaps on them. And they look good.
Are they overcapitalised?
They're always these ones will be overcapitalised.
They'd be massive. Yes. But imagine you know what? Some people strategically, and I know people do this, right? They specifically buy properties because they got massive, depreciation on the front. The issue is that are they the second owner? Can they claim all of the? Tell me about this, because if you buy an incomplete house or something that has just been built by a developer, who actually gets to claim the depreciation on it?
So the main thing of your question there is really if more has been spent on construction than you pay for it, you claim based on what's been spent on construction. So in some previous block experiences, should I say, because you can see the numbers out there on those, you Google around and find them, they often spend substantially more than what the purchase prices are.
Yes.
So if I was to, go and buy a house that someone's spent $1 million building and I paid $700,000 for it, then the depreciation relates to the construction cost, not the purchase price.
And you need to show evidence of that $1 million in construction cost, which you can do through evidence the reason the quantity survey is there is about cost. So if I tell you it costs $1 million and you bought it for $700,000. Does it happen often?
Not that often. No. It does happen on the block properties.
So
absolutely.
Who gets to claim the depreciation on that? Is it the eventual buyer of that property? So who originally owns the property? Is it Channel 9? I don't know.
Channel 9 would originally own them. Yeah. They substantially renovate them and the buyer will get to claim the depreciation on those.
Okay.
So the same with your developer. If your developer actually loses money out of a property and sells it on, the depreciation goes to the person that buys the property, and it's based on the construction cost, not necessarily the sale price. We've done a number of them over the years that do have that situation where the developer, something's gone wrong and it's cost a lot, or the market has really tanked. Yeah. It's not a regular thing, but I remember doing a big shopping centre that the first developer's gone bust. Someone's bought it at a fraction of what it's cost to build. And so the new owner, massive depreciation.
And they would have seen that as part of the asset they were buying. They're like, absolutely. Look, I'm buying all this depreciation.
Absolutely.
Might fix a tax bill they might have somewhere else. But this is where it gets really super strategic, right? Which is probably beyond most most sort of mum and dad property investors, but
It is, but so those Phillip Island ones, what they've spent on them versus what they expect to get as prices, like Phillip Island will have a ceiling on what sort of price you're able to get because they've got to, when they sell them, they've got to come into the current market of what they can get, right? The same with.
Are they regional? Are they acreage, or are they just
No, it's like a there's 5 houses in a little resort style development.
Okay.
They've retained a pool and a tennis court, and they've built a big what do you call it? Like an area that's got pool tables and a men's shed almost.
So it'd be strated. It's a strated.
So they should end up strated. They'd have a piece of that each. So they're probably likely to be short-term traveller accommodation of some sort.
Yeah,
and
someone would buy the lot, I reckon, and make it a big Airbnb. And
you could buy one and do that. And I think they were telling me about some research.
Are you an interested buyer, or are you conflicted?
No. Well,
quick.
Apparently, Phillip Island has the least or the most nights per year that the accommodation's full and you can't find anything in Australia from some research they
And
have
imagine
done.
they don't have silly rules like they put in some other jurisdictions saying you can only have so many nights per year, which is rental accommodation. No doubt people are looking at this.
Probably doesn't have as much of a problem there, I don't think. But
Byron Bay.
As Byron Bay probably does. Look, the numbers, if they're right, look not bad from a like if you can buy it for that, your depreciation is massive. And if it is short term, and that research which was done in regards to another development that's being built there that they told me about, then if it's full that much and you can get the sort of top numbers there, then I don't know, maybe it will work out as the numbers being okay. But I mean, like any property, you've got to look at all facets.
Yeah. Do
I make capital growth? Do I this? Is the cash flow?
That's what it comes back to rather than – but I imagine they're nice, specced out places, yeah. Are they done? Are they finished? On
I was down there a few weeks ago and they were just about done except for all the mud outside that I had to run through, of course.
Do you go down for the actual auctions and stuff? No,
I don't need to go to the auctions. Well, we've done the filming for the bit that we're going to do, which is a construction cost breakup, and we interviewed each of the couples. And this one's interesting. They were given a task the night before to come up with the construction cost, and then an opportunity for them. They come and ask me a bunch of questions.
How'd they go?
There was some
not talking out of school.
Questions.
So
look, I'm not talking out of school. They. Some of them had some pretty interesting questions, and they just needed to make sure they thought of everything that might be in there. And so it was like they'd done a bit of work the night before, and almost back to the drawing board after an interview with me.
Can you claim labour as part of it all?
Their labour, no, because they're not paid for the labour, but the labour in relation to construction. So you pay your workers that built it. Yeah. It's part of the construction cost. You can't put bricks there without a brickie.
So you just don't go, the plasterer, I don't just count the plasterboard, I count the plasterboard and the time for the person to do it, plus all the materials and the nails and the glue and everything.
Absolutely. So you'll go in and work out. And when
time and materials.
Time and materials. And when we look at some of the plant and equipment, the way we cost it for the purpose of depreciation. So even if you're given some actual costs, it's a good question because some go, well, I've got the costs from the builder. Well, you do have the cost of the hot water service that they paid, not the supply and install and whatever other associated costs with the hot water service. When you see our depreciation schedule, the hot water service sometimes looks a bit expensive because the way we treat it for depreciation is to maximise the deduction and put everything related to getting that hot water service there and operating. You don't buy a house and then go down to Ream or Bunnings and buy a hot water service. You buy it, cook and water. And it's the cost of getting it there that you're depreciating based on.
So this is really practical, but thinking as a property investor, a lot of people put sweat equity into stuff, right? They go, I'm going to do a reno. I'm going to do it all myself. So that could potentially compromise your ability to claim deductions because you can claim for the material, but if you're a DIY weekend hero, you can't claim your own time unless you were probably a licensed
Your time needs to be paid. It needs to be – so, yes, your depreciation will be less if you're going to do some of this work yourself.
But can you actually pay yourself?
You need to do that properly and then pay tax on the income and all of that messed around for a bit more depreciation is probably not worth it.
So it starts getting really like when you scratch the surface. A lot of people think, look, I've done this thing. Normally it would have cost $100,000, but because I did it myself.
It cost 95.
95 or whatever,
So then when we do that depreciation, time.
Here's a question for you. Give me a percentage. So if I'm going to spend $100,000 on the reno, normally done, whatever it is, it doesn't matter. What would typically be materials versus time?
That's a
How long is a piece of string?
Yeah, that it so depends on like if I buy a $95,000 item and put it in and it doesn't need much attaching, then versus the bricky.
Yeah.
So really hard question to answer. But in any renovation you're doing, it's like whenever you do something yourself. Like I think, I've done plenty of renos of my own in the early days. Then think of your time and your value in that time and what, like if you paid yourself to do it and what's the difference and is it worth it, right?
Yeah.
Sometimes,
You get
especially
to that
when
point,
you're not
right?
expert at it.
No, and it gets to the point, like early on when I was investing, probably much like you used to do a lot of it yourself, which was good because you learned a lot as well, right? You didn't have the money, but also it gives you it's a real good ability to actually understand eventually where you go, well, my time is better spent doing something else than this, and whatever that is, it's irrelevant. But when you get a quote for work and you go, mate, that doesn't take that long because I've done it myself. To paint a house, it's going to take me about this long. It's probably about $6,000, $7,000, whatever it is. You're trying to charge me $50,000 for painting, mate? No way. Yeah. So you've got to do it yourself. You've
got to have a little look at some of those quotes sometimes, but you've also got to realise that when you and I were probably doing our own renovations, however many years ago for you,
it's
but
quite
it's
a lot.
15 or 20 for me, then the cost of things have increased and they cost a bit more than we're probably used to, but then it's the same. You get your valuations down and go, well, that's gone up more than I expected. Yeah. So we've got to be realistic, but then also think about the time we spend doing that. And if you're busy and you can be effective at what you're good at, then sometimes it's okay to pay. But I did a lot of the first renovation I did, without any cash left because it all went into the buy and my and a big credit card bill and a refinance to help me get the cash back again at the end of it, right? So I was not paying tradies when I didn't need to.
I was start somewhere.
Climbing in the roof in the middle of the night, helping out, doing stuff,
start somewhere. So the block, Melbourne Eye. So that's a commercial building, I imagine.
It's all, it's cost a lot, that thing, because it's had a few issues. So there's lots of costs involved in that.
Yeah.
The big banana. The big banana, close to, my hometown of Tarrant.
Yeah. That's just a piece of fiberglass, isn't it?
But I don't know. I haven't been there since I was a kid. I didn't do it.
Yeah, okay.
Oh, the big rocking horse in Adelaide. We like our big stuff. Yeah. So there's definitely some interesting stuff.
You must do like a lot of celebrity stuff as well, which you probably don't talk about, like celebrity houses and
celebrity houses. Some of the TV shows you watch that are hosted in places, things like that. That's interesting. You find out, and there's definitely some. Like lots of people that buy properties, you see some names and go, "Oh, that's interesting,"
is that what they paid, right?
You don't even need that. No. You can find most of that stuff through the data houses these days, but we do see some people that buy some interesting stuff.
What's the most expensive house that you guys have probably done appreciation on?
I don't know, Phil, actually.
Probably some of those eastern suburbs, Point Piper type things.
Yeah, some Point Piper and eastern suburbs. Sometimes if people have bought things that are in, and where we see expensive ones is when we are they've been a principal place of residence, really. So they're really a principal place of residence that someone's had to move away and they rent it out for a period of time.
Okay.
And then, you see some expensive stuff up around, and things that are used for Airbnbs as well. There's expensive stuff up around Byron Bay and a lot of Whale Beach, Palm Beach and that sort of stuff. I don't know what the most expensive, I'd know what that is if I had a look at the system, but
cool.
There's some interesting stuff.
All right. So the key point is that if you're going to, if you're behind on your depreciation reports or you haven't yet done it and you've acquired property this financial year, get a depreciation report done. Point number one. In terms of timing, you can pay for it this year, so it falls into this tax year.
Yep.
And you can actually do the report a little bit further down. But if someone wanted to actually pay and get it done with 10 days left in a year, it's probably pushing it, right?
That could be pushing it. And unless, we visit the properties, important part of the process, make sure we find everything and we can back it if you're getting audited. And I'm here to get the most money out of it. I don't find things. I won't get the most money out of it. And, tenants don't like me ringing up and saying, excuse me.
Yeah, tomorrow I need to come in.
Tomorrow I'm coming at 3 o'clock. We try to work with them a little bit better than that.
No, it's good. And you've got to look after your tenants, but you can actually just get it squared away and pay for this financial year. That's smart business. Now, Brad, what's the best way to I would just Google BMT tax appreciation. It's probably the easiest way to track you guys down.
Yeah, look, bmtqs.com.au.
Yep.
We're pretty easy to find. That's not
pretty
too hard.
easy. Yeah, and how does it all work? Someone will contact you, your just speak to someone, get some details, and then
Yeah, absolutely.
Yeah.
I mean, the first thing we want to do is talk to you about your property and the address and make sure it's something worthwhile. And then, you can fill out forms online, you can get quotes there, or you can talk to us and we'll go through it all on the phone and fix it up for you. And then
Too easy.
just look after it from there.
Well, thanks for coming in. I'm happy I've got my stuff sorted now and I have to worry about it until I buy something new again.
Phil, that's great. I'm glad you've got it sorted. Go back and amend some previous years, and let's. I think for you, as you buy it, when it happens, what you should do is go. Part of that is while I've got all this stuff in front of me, let's go get it done.
It's a really important point. Like when you're buying something, just get your depreciation report done. Then it's a tax deduction. It's pretty simple. And like me, my accountant sort of did everything, so that's pretty simple.
It's great.
Works for me. Brad Beer, BMT, go and check them out. BMT Tax Depreciation, Google them, track them down. That's a lot more interesting than what I thought it would have been, Brad.
That's great, Phil.
Who would have thought tax depreciation was exciting? I get excited about tax depreciation now. I've changed my tune.
Done a few of those with you, Phil, over the years, and they're always good fun. I love talking property, and we can do a bit of that and whack a bit of depreciation in there on the side.
Yeah, mate, keep up the good work, and no doubt a lot of people are a lot more educated around property as a result of the work that you've been doing for well over 2 decades. So thank you, BMT. Google it. This smartpropertyinvestment.com.au. We write a fair bit about tax depreciation, to be fair, so you can go and find more stuff. And no doubt your website's full of know-hows and
absolutely
doodads and all that sort of stuff.
Plenty of tools, things to help estimate it, to crunch your cash flow, all sorts of stuff.
All that stuff. Cool. Smart Property HQ, social media, or Smart Property Investment. Find us there. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finny. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finny mortgage specialist on 02 8866 2444 or visit our website at www.finny.com.au.